Well, the supply chain is an issue, but we know that the coronavirus has been around since early January. And since then, the NASDAQ 100 was up over 11% until this morning. So we had some softer economic news with the PMIs. But I think that the fact that the NASDAQ had been strong up until today, living with the coronavirus was an indication that it's not as big as an issue, for at least for the tech sector, as people fear. It definitely has some implications across the U.S. economy, particularly if it were to spread. But technology is a very diversified sector. The supply chain and the contract manufacturers are exposed to China, but the software companies are not, IT services are not, the internet companies are not. So there's a lot of opportunities still within tech, despite the isolated instance with the coronavirus in China.
What about specific companies like Apple that directly warned about the impact? Do you also think that concern is overstated, or are you just saying that there are plenty of companies without that level of exposure?
I think when it comes to a company like Apple, we can expect to have lower iPhone numbers as a result of supply issues and manufacturing issues. That's to be expected. I think the market is basically assuming that that demand just gets pushed out and not replaced, given the uniqueness of an Apple device and the iPhone itself. And we'll probably see other companies announce that the manufacturing process has slowed. But again, it's not going to destroy the demand, just push it out. And we have yet to see the coronavirus really turn into a global pandemic beyond the response that we've seen. So as long as we continue to hear these comments about the precautions being taken and the quarantines and the various steps, I kind of feel like the market understands the issue and it seems to be under control. And it's really those issues that the market doesn't understand or that pop out of nowhere that tend to be a bigger problem.
Given the outperformance we've seen in mega cap tech stocks and what seems to be an emerging sentiment that these are almost in of themselves defensive plays, given all of the uncertainties and the weight that is having on the broader market right now, is that the best place within tech more broadly for investors to be investing, or do you see opportunities in maybe some of these smaller, medium-sized names that have been high-flying but hit hard?
Well, the high-flying names have a higher valuation risk. And if this does turn to more of a deeper correction, given the fact that we've had a good run year to date, given the fact that the tech sector was up strongly in 2019, the higher valuation is going to be more of an issue. But throughout large cap stocks, you have some companies that are blue chip names that are trading at PE multiples, half of the S&P 500, and yet off a dividend yield twice as much, and free cash flow yields anywhere from 6 to 10%. Household names like Cisco, Intel, IBM, these are blue chip U.S. technology companies that have good outlooks.
What's your take, Robert, on the level of valuations we've got across tech? As clearly, it's a rich sector relative to the rest of the S&P 500. But what's it like relative to the private market tech valuations that we've seen?
Well, the private markets are the valuations that I would probably be most concerned with. There's been a lot of money flowing into either venture capital and private equity over the last 5 years. And I don't want to call it a bubble, but I feel there's a lot of money chasing fewer and fewer opportunities. And the industry has risks. The length to exit for a lot of these private companies has extended. A lot of the IPO valuations we're seeing have not been good. And you combine the length to exit, the difficult IPO market, and the amount of money chasing an asset class, those are all kind of indications that you need to be careful.